Welcome to the Deep Dive, where we cut through the noise and get straight to the insights you need. Today, we're plunging into the story of a company you might not often hear about, but whose remarkable transformation is truly a masterclass in corporate strategy, Arcosa, Inc., that's traded on the NYSE under the ticker ACA. Our mission today, guided by, well, a stack of comprehensive sources from detailed investment analyses and recent earnings releases to extensive SEC filings, is to unpack Arcosa's dramatic strategic pivot. We're here to extract the most important nuggets of knowledge, understand why this company has so deliberately reinvented itself, and most importantly, explore what this profound shift means for you as a well-informed observer or perhaps a potential investor. Get ready to discover the fascinating and foundational world of infrastructure through a truly unique lens.
That's right. Arcosa is fundamentally a provider of critical infrastructure-related products and solutions. But while that might sound like, a broad mandate, the real story here isn't just about what they do, it's about how dramatically they've evolved. From their origins as a diversified industrial manufacturer, they've undergone a profound, almost aggressive strategic shift. This dramatic change and the very deliberate steps they've taken to engineer it is truly the central theme of our deep dive today. It's a compelling case study of a company actively designing its own future, rather than just, letting it happen.
Okay, let's unpack this transformation because it's clear Arcosa wasn't always the focus company we're discussing today. Tell us about its origins and give us the big picture of this strategic shift. What was the catalyst for such a dramatic reorientation?
Well, Arcosa, headquartered in Dallas, Texas, actually began its independent life quite recently. It was spun off from Trinity Industries, Inc. on November 1st, 2018, immediately becoming an independent public company. And what's truly insightful here is that from its very inception, Arcosa didn't just passively continue Trinity's legacy. Instead, it embarked on a significant strategic transformation right out the gate. This wasn't a slow evolution. It was a deliberate, almost immediate pivot, demonstrating remarkable proactivity for a newly independent entity.
So it leveraged its newfound independence to immediately chart a new course. What was the core of that shift away from being a, diversified industrial manufacturer?
Precisely. The core strategy was to move away from that diversified industrial manufacturer model, which often entails a complex mix of businesses with varying cyclicality and margins, towards becoming a much more focused, higher-margin entity with a core emphasis on construction materials. This wasn't an accidental drift. It was driven by a disciplined strategy involving both organic growth from within and, most notably, a series of strategic acquisitions and divestitures. This buy-and-sell approach was specifically designed to reduce the overall cyclicality in their business and enhance long-term shareholder value. The real genius here, I think, is how quickly and deliberately they engineered this new identity post-spinoff. Many companies sort of flounder after separation. Arcosa leveraged its newfound independence to pivot towards a structurally superior business model, effectively de-risking its future in, record time.
That's a huge undertaking for any company, let alone one just starting its independent life. To truly grasp this shift, we need to understand the moving parts. Walk us through the specific pieces of its business and how their importance has changed over the last few years, say 2022 to 2024.
Certainly. Arcosa reports its financial results across three principal business segments: construction products, engineered structures, and transportation products. And as you noted, the composition and, more importantly, the strategic significance of these segments have shifted dramatically, particularly between 2022 and 2024. Let's start with construction products. This segment has truly become the new cornerstone of Arcosa's long-term strategy, and it's now its largest contributor to both revenue and profitability. It essentially provides the fundamental materials needed for a wide range of construction projects, from public infrastructure like roads and bridges to residential and commercial buildings.
So this is where we're seeing the major investment and strategic focus, right? What kind of materials are we talking about here, and what makes this segment so critical?
Precisely. Within construction products, there are a few key areas. The first, and perhaps most important, is natural and recycled aggregates. Think crushed stone, sand, and gravel. These are the fundamental building blocks of almost any construction project. These materials are sourced from quarries, and here's a critical insight. It's inherently a local business. Transportation costs for aggregates are incredibly high, which means quarries located near high-growth metropolitan statistical areas, or MSAs, have a significant and sustainable competitive advantage. This localization is a crucial detail, creating a natural moat.
That makes perfect sense. Hauling tons of rock across long distances would just eat into any profit, wouldn't it? So proximity is everything.
Exactly. And this plays directly into a specific example of their strategic intent. The transformative October 2024 acquisition of Stavola Holding Corporation for a massive $1.2 billion. This wasn't just any acquisition. It gave Arcosa a scaled, vertically integrated aggregates and asphalt platform right in the New Jersey and New York metropolitan area.
Which is the nation's largest market, right?
The largest market. The real genius of the Stavola deal. It's Arcosa's land grab in the nation's toughest, most lucrative construction market. By vertically integrating in New York, New Jersey, they've built an almost unavailable local moat, ensuring predictable cash flow regardless of broader economic shifts. It's a true masterstroke for a company trying to shed cyclicality. Beyond aggregates, construction products also include specialty materials, which are more niche items like natural lightweight aggregates, plaster, and asphalt, serving specialized construction and industrial applications. And finally, they offer construction site support by manufacturing and selling drench shields and shoring products, vital safety equipment for excavation work.
Okay, so having established construction products as the bedrock, let's turn to engineered structures. This segment, while maybe less near than aggregates, plays a pivotal role in Arcosa's infrastructure strategy because it covers some pretty heavy-duty stuff. What does that entail?
It absolutely does. Engineered structures manufactures large fabricated steel and concrete structures that are critical components for various types of infrastructure: energy, transportation, communication. The largest part of this segment focuses on utility, wind, and related structures. This includes producing tubular steel and concrete structures for electricity transmission and distribution grids, primarily through their highly regarded Meyer Utility Structures brand. They're also a leading North American manufacturer of structural wind towers for the renewable energy sector, and they produce steel structures for telecommunications and traffic control.
That's a broad portfolio within one segment, covering essential infrastructure components. Did they expand this recently as well? Sounds like they're active across the board.
Yes. Another specific example of their growth here was the April 2024 acquisition of Amron Pole Products. This expanded Arcosa's offerings into the premium concrete and steel lighting pole market, further solidifying their position in critical infrastructure components. The Meyer Utility Structures brand, in particular, carries significant weight, over 60 years of experience and a hand in authoring many industry standards. That's a testament to their engineering expertise and established reputation. Now let's discuss the transportation products segment. This represents Arcosa's legacy business, and it's also the most cyclical of the three. As part of their strategic pivot, Arcosa has been actively reducing its exposure to this area. This is another thread in Arcosa's carefully woven narrative of self-reinvention.
So this is a part of the business they're actively trying to move away from, right?
Right.
Makes sense given the focus on reducing cyclicality. What does this segment involve, and what was a key strategic move in this area?
Precisely. It primarily involves inland barges, where Arcosa manufactures dry cargo and liquid barges for bulk commodities like grain, coal, petrochemicals used on U.S. inland waterways. The most telling strategic move here, however, was the divestiture of its steel components business on August 16, 2024. This business produced components for rail cars and other industrial equipment. This was a very deliberate step to simplify their portfolio and, crucially, to reduce their exposure to the highly cyclical rail car manufacturing market. This divestiture is absolutely critical to remember when you're looking at year-over-year financial comparisons, as it significantly changes the base for analysis and clearly signals the company's long-term direction.
That makes the shift very clear. It's not just a reallocation of resources, but a fundamental reshaping of the company. So, with these distinct segments in mind, how does Arcosa knit them together day to day? Their operating model isn't just about managing three different businesses, is it? It sounds specifically designed to amplify the strengths of each, especially that new construction products cornerstone, maybe by focusing on localized dominance.
Yeah, Arcosa's operating model is quite focused. They aim to achieve leading positions in what are often fragmented infrastructure markets. Their strategy for generating value is a dual approach. First, they drive organic growth through operational excellence and by expanding capacity at existing sites. Second, and equally important, is a disciplined acquisition strategy. They have a clear preference for acquiring what they call platform businesses in attractive markets. These are established companies that can then be scaled up through smaller, synergistic bolt-on acquisitions and further organic investment.
So they're not just buying small pieces, but established foundations that they can then build upon, almost like a private equity-style roll-up, but within a public company structure.
Exactly. This private equity-style roll-up model is key. It means they identify fragmented industries, like aggregates, acquire an established player as a platform, and then consolidate smaller, often family-owned businesses around it. This creates significant value by acquiring at attractive multiples, integrating for synergies, and benefiting from higher public market valuations assigned to larger, more diversified entities. The Stavola acquisition, which we discussed earlier, perfectly illustrates this model. It provided an immediate, margin-accretive platform in a new, high-value geographic market, the New York and New Jersey metropolitan area, which they can now grow further. In terms of their geographic footprint, Arcosa's operations are predominantly focused on the United States. While engineered structures and transportation products serve a broader North American customer base, the construction products segment has a more significant geographic concentration. You'll find a strong presence in Texas and, post-Stavola, a very critical foothold in the Northeast. This regional focus is, again, key for aggregates due to the absolute necessity of being close to end markets.
It's easy to paint a rosy picture of growth, but no transformation is without its hurdles. So let's pull back and consider the broader economic context Arcosa had to navigate. What challenges did they face between 2022 and 2024, and how did they adapt, especially mid-transformation?
That's a critical question. Cyclicality can make or break a company, and traditionally, industrial firms are very exposed to it. So how has Arcosa's deliberate strategic shift impacted the inherent volatility of its business model?
Yeah, that seems like the million-dollar question. Did the strategy actually work in smoothing things out?
That's the crux of their strategy, and it's a vital insight. A core tenet of Arcosa's strategy since 2022 has been to intentionally reduce the overall cyclicality of its business mix. They've achieved this by investing heavily in the inherently less cyclical construction products segment while simultaneously divesting more volatile manufacturing businesses. This isn't just about tweaking, it's about fundamentally changing the company's economic sensitivity. Let's break down the cyclicality of each segment. Construction products is significantly less cyclical. Demand here is underpinned by stable, long-term drivers. Think about public infrastructure spending, often backed by multi-year legislation, like the Infrastructure Investment and Jobs Act, or IIJA, which provides a visible, long-term demand runway. Repair and maintenance activities, which are constant in population growth, also create relatively steady demand. While it does have some sensitivity to interest rates in the housing cycle, it's fundamentally much less volatile than, say, heavy equipment manufacturing. That's a powerful hedge.
So consistent demand, less tied to boom and bust cycles. And what about engineered structures? Does it offer similar stability, or is it more complicated?
Engineered structures has a mixed cyclicality. The demand for utility structures, for instance, is relatively non-cyclical. This is driven by essential needs like grid modernization, improving reliability, hardening the grid against extreme weather, and the long-term trend of electrification. These are non-discretionary investments. However, wind towers, also part of this segment, are more cyclical. Their demand is highly dependent on federal energy policy and tax incentives, such as those provided by the Inflation Reduction Act, or IRA. So one part provides stability, the other is more policy dependent and can be, volatile.
Okay, that makes sense. A bit of a mixed bag there.
Right. And finally, transportation products remains Arcosa's most cyclical business. Demand for new barges is directly tied to the health of the industrial economy, commodity prices, agricultural yields. When those fluctuate, so does barge demand. This is precisely why the divestiture of the steel components business, which served the similarly cyclical railcar market, was such a significant and deliberate step toward reducing earnings volatility in this area.
So this isn't just shuffling assets, it's a profound change in how the company earns its money and manages risk. It's almost like they've built a new engine for the business, one designed for smoother sailing through economic storms.
Exactly. This isn't just rebalancing, it's a fundamental shift in identity. Arcosa, which spun off from Trinity Industries, a classic industrial manufacturer, has very strategically used its capital to transform into an aggregates-led construction materials company. They've deployed over $2.7 billion in acquisitions, with the $1.2 billion Stavola deal being the crowning achievement, firmly establishing construction products as the center of gravity. It now represents a majority of its earnings. This pivot fundamentally alters the company's primary growth drivers, its risk profile, and, critically, the set of publicly traded companies against which it should now be compared and valued. The insightful takeaway here is that they're proactively shedding their past identity to embrace a future with more predictable, higher-quality earnings.
So Arcosa has consciously reshaped itself to align with specific market opportunities and to mitigate those cyclical risks we talked about. What are the broader industry trends and the powerful government policies it's really banking on to fuel its future?
Well, Arcosa's performance is intrinsically linked to the health and trajectory of the North American infrastructure, construction, and transportation markets. The U.S. construction materials market, for instance, is absolutely vast and essential. It was valued at $145.0 billion in 2024 and is projected to grow at a compound annual growth rate, or CAGR, of about 4.0% through 2032. This growth is structurally supported by ongoing infrastructure development, the constant need for residential housing, and various government modernization projects. In fact, the residential sector is the largest end market, accounting for something like 45% of demand in 2024.
Okay, so a huge market with built-in growth drivers.
That's exactly. However, it's not all smooth sailing. The industry does face some near-term headwinds. After a strong 6.5% real growth in 2024, the U.S. construction industry is actually expected to slow sharply to just 1% growth in 2025. This deceleration is primarily due to weaker investor and homebuilder confidence, elevated interest rates, and rising construction input prices. But looking further out, there's a forecasted recovery, returning to a more normalized 1.9% average annual growth from 2026 to 2029, supported by continued investments in transportation, manufacturing, and housing projects.
This raises an important question. How does Arcosa plan to navigate that near-term slowdown? This is where government policy steps in, right? It sounds like those massive infrastructure bills we've been hearing about will be absolutely crucial for them.
Exactly, and you've hit on a crucial point. A powerful countervailing force to that cyclical slowdown in private construction is the substantial, multi-year federal investment in public infrastructure. This is a powerful tailwind for Arcosa. Two key pieces of legislation are at play here. First, the Infrastructure Investment and Jobs Act, or IIJA, signed in late 2021, allocates approximately $1.2 trillion.
$1.2 trillion. That's a staggering amount.
It really is. And this includes significant new funding directly for Arcosa's key end markets. $110 billion for roads and bridges, $73 billion for power infrastructure and grid modernization, $66 billion for rail, and $17 billion for ports and waterways. The insight here is that the IIJA provides a visible long-term demand runway for their construction products, particularly aggregates and specialty materials, and for their engineered structures, like utility structures. This isn't just a bump in spending, it's a multi-year commitment that offers a unique layer of demand resilience.
That's a lot of money directed right at what Arcosa does best, creating a kind of government-backed insurance policy on their growth almost. And what about the clean energy push? That seems like another massive trend they're tapping into.
That brings us to the Inflation Reduction Act, or IRA, which provides roughly $370 billion in investments related to energy security and climate change. The long-term tax credits embedded in the IRA are a critical demand driver for renewable energy, directly supporting order activity for Arcosa's wind towers business. So what does this massive federal spending mean for you, the individual investor or observer? It means Arcosa has a uniquely de-risked demand pipeline, even if the broader economy stumbles. While private construction may soften, these federally funded public infrastructure projects, which are core demand for Arcosa's growth segments, are actually expected to accelerate, significantly enhancing their earnings resilience through economic cycles. The pace of IIJA fund disbursement by states is a key variable to watch, but the overall picture is one of strong, long-term support for their core businesses.
Okay, so strong policy tailwinds. What about the legacy side, the transportation equipment industry? You said they're reducing exposure, but how's that sector looking?
Yeah, let's briefly touch on the transportation equipment industry. This sector is massive in the U.S., about $2 trillion in annual sales. However, 2024 was quite challenging for freight, with muted demand, high inflation, and sluggish economic growth. This difficult environment directly impacted demand for new equipment, really validating Arcosa's strategic decision to reduce its exposure to this more volatile segment. The long-term outlook, though, isn't entirely bleak. The North American railroad market is projected for a 5.3% CAGR from 2025-2030 due to modernization efforts. And ship and boat building expects healthy, albeit slowing, growth of 7.9% annually through 2027, which supports baseline replacement demand for inland barges. So there's still some underlying demand.
Right, but the bigger picture validated their move away from it.
Yeah, definitely. Finally, we need to consider supply chain and raw material cost pressures. Post-pandemic, construction material prices showed some signs of stabilization in 2024, with some decreases in things like framing lumber, but pressures persist in other areas. For example, concrete blocks surged over 6% in Q1 2024, and fiberglass insulation rose over 20% year over year. Labor costs, particularly in transportation equipment manufacturing, were also a significant headwind, rising 9.5% in 2024. For Arcosa, managing these fluctuations is critical. Their strong pricing power in aggregates provides a solid hedge against inflation. Even more strategically, increasing vertical integration within their construction product segment, for instance. Owning quarries that supply their own asphalt plants offers a significant advantage in controlling raw material costs and preserving those crucial margins. It's a proactive defense against external cost pressures.
It sounds like they're well positioned to navigate these challenges, particularly with the government tailwinds and their strategic shift. But what about the competition? Who are they up against in these diverse markets, and what's their secret sauce for standing out, especially when going head-to-head with much larger players?
That's a fundamental question, and it really highlights Arcosa's regional shark strategy. Arcosa operates in some very diverse markets, ranging from highly fragmented local industries to more concentrated national ones. Their strategic goal is consistently to achieve leading positions in these various competitive landscapes. In construction products, specifically aggregates, the industry is structurally fragmented. You have thousands of small operators. However, at the national level, it's dominated by a handful of very large public companies. So Arcosa's key competitors here include industry giants like Vulcan Materials Company, or VMC as it's commonly known, and Martin Marietta Materials, Inc., MLM. You also have the North American operations of CRH PSE. These are companies with market capitalizations many times that of Arcosa, operating vast networks. Arcosa isn't trying to compete with them nationally on sheer scale, but rather through targeted regional dominance.
So they're not trying to be a giant in every corner, but rather a dominant force in specific high-value areas. It sounds like they're choosing their battles very carefully, picking their spots.
Exactly. Then in engineered structures, particularly utility structures, the market includes large, vertically integrated steel producers and specialized engineering firms. Here, key competitors include Nucor Corporation, NUE, which is North America's largest steel manufacturer and has a dedicated towers and structures division. Valmont Industries, VMI, is another significant publicly traded player, along with various private firms. Arcosa competes here through specialized expertise and established brand reputation, like Meyer Utility Structures. Finally, in transportation products, focusing on inland barges, the industry is more concentrated. Major competitors include Kirby Corporation, KEX, which operates the largest fleet of inland tank barges in the U.S., and large privately held operators like Ingram Barge Company and American Commercial Barge Line, ACBL.
Given this varied landscape, Arcosa must have some distinct competitive advantages. What are their moats, those things that protect their business from competition and allow them to thrive against such formidable players?
Indeed, Arcosa has carefully cultivated distinct competitive advantages, or moats, within each of its segments. In construction products, particularly aggregates, the most durable moat is geography. As we discussed, aggregates are heavy and expensive to transport. This means that quarries with high-quality reserves located near major construction markets have a significant sustainable cost advantage. Think of it like a medieval castle builder. They're not just putting up walls, they're digging impassable ditches right where the enemy would need to cross. Arcosa's strategy of acquiring and developing assets in high-growth metropolitan statistical areas like Dallas-Fort Worth and, crucially, the New York-New Jersey region through the Stavola acquisition is a very deliberate moat-building exercise. They're securing these advantaged positions and locking in market access.
That's a classic economic moat, a natural barrier to entry. What about engineered structures? What's their secret weapon there? Is it just scale?
In engineered structures, their competitive advantage is built on engineering expertise, manufacturing scale, and quality certifications. For instance, Arcosa's Meyer Utility Structures brand has over 60 years of experience and has actually helped author many industry standards. Obtaining necessary certifications, like those from the American Institute of Steel Construction, or AISC, create significant barriers to entry. Add to that their deep, long-standing relationships with major utility customers and wind turbine original equipment manufacturers, or OEMs, and you have a very strong position built on trust and technical capability. For transportation products, advantages are derived from manufacturing efficiency, a strong reputation for quality and reliability, and production scale. Their existing backlog also provides production and revenue visibility, which allows for more efficient planning and consistent operations.
So how does this translate into market share and pricing power, especially for their core aggregates business, where they're up against those national giants? Are they a big fish in a small pond or a regional shark?
Nationally, Arcosa is a smaller player compared to the sheer scale of Vulcan Materials or Martin Marietta in aggregates. However, their strategy is clearly one of targeted regional dominance. Instead of trying to compete everywhere, they acquire scaled platforms in specific geographies, aiming for dominant, defensible positions in high-growth regional markets.
This regional shark approach allows Arcosa to benefit from local density and logistical efficiency, creating a powerful moat against both the national leaders and smaller local players.
That makes perfect sense, but that also sounds like it could concentrate their risk geographically. What if a major regional project falls through or local regulations shift unexpectedly?
That's a valid concern. The risk here is geographic concentration. A significant economic downturn or unexpected regulatory changes in regions like Texas or the Northeast would disproportionately impact their most profitable segment. However, we've seen powerful evidence of their pricing power that mitigates this. In Q2 2025, Arcosa implemented an 8% increase in freight-adjusted average selling prices for aggregates while still growing volumes by 6%.
Wow, 8% price increase and volume still went up.
Exactly. That's powerful evidence of significant local market pricing power, which indicates a strong competitive position and the ability to pass through costs. For their other segments, they describe themselves as a leading manufacturer of wind towers and an industry leader in utility structures, implying significant market share in those more concentrated industries. Pricing power in these areas is more project-dependent and can be influenced by raw material costs, particularly steel.
This transformation sounds impressive on paper, and the strategic rationale is compelling. But how has it actually translated into their financial results, particularly from 2022 to 2024? What does the balance sheet tell us about the success of this pivot?
This is where the rubber meets the road, right? And the numbers tell a very clear story. Arcosa's financial results from 2022 through mid-2025 clearly reflect a period of profound transformation and strong growth, both at the top and bottom lines. Consolidated revenue growth has been robust, driven by both those strategic acquisitions and organic expansion in their targeted segments. For the full year 2024, revenues increased 11% to $2.57 billion from $2.31 billion in 2023. Now, it's important to note that this figure includes the results of the divested steel components business for part of the year. When you exclude that divested business, the underlying growth rate was an even stronger 15%.
Okay, so the underlying growth is even better once you adjust for that strategic sale.
Exactly. This trend of strong growth continued into 2025. In the second quarter of 2025, revenues grew 11% year over year to $736.9 million. Again, excluding the divested business, that growth was an impressive 18%.
And how did each segment contribute to that? Was the shift away from legacy businesses and towards construction products clearly evident in the revenue numbers?
Absolutely. The segment contributions for fiscal year 2024 clearly illustrate their strategic execution. The construction products segment, our new cornerstone, grew revenues by 10.4% to $1.11 billion. Engineered structures expanded by a substantial 19.9% to $1.05 billion. In stark contrast, the transportation products segment saw its revenues decline by 3.7% to $417.6 million. The numbers undeniably reflect the pivot, showing where capital and focus have been directed and where growth is being generated.
It's fascinating how clearly the numbers track the strategy.
What's truly fascinating here, though, is the profound impact on their bottom line. How has this strategic shift influenced Arcosa's profitability? This isn't just about growing revenue, it's about growing profitable revenue.
Profitability is always the ultimate measure, isn't it? Especially for a company that's so aggressively reshaping its portfolio.
It truly is. And here, the most compelling aspect of Arcosa's recent financial performance has been significant and accelerating margin expansion. For the full year 2024, adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, a key measure of operational profitability, grew 22% to a record $447.0 million. Their adjusted EBITDA margin expanded by 150 basis points to 17.4%. And if you normalize for a large land sale gain in 2023 and the impact of the steel components divestiture, the underlying margin expansion was an even more impressive 260 basis points.
Wow, 260 basis points underlying. That's a significant jump.
It really is. And the positive impact of this portfolio transformation became even more pronounced in 2025. In the second quarter of 2025, Arcosa reported record-adjusted EBITDA of $154.2 million, a 37% increase year over year. And their adjusted EBITDA margin reached a record 20.9%, a 390 basis point improvement from the prior year. This is not just incremental improvement, it's an accelerating structural shift in their profitability.
That's incredible margin growth. What's the biggest driver there? Is it simply the change in business mix, or is something else at play? Good execution.
It's both, really. The key driver for this margin enhancement is primarily the growing contribution from the highly profitable construction products segment. This segment posted an adjusted segment EBITDA margin of 28.3% in Q2 2025, which is fantastic. This high-margin business
is steadily replacing those lower-margin manufacturing businesses, structurally lifting the company's overall profitability profile. But it's more than just a mix shift. This margin expansion is also strong evidence of their operational execution and pricing power. In Q2 2025, the company's aggregate adjusted cash gross profit per ton grew by 15%, a direct result of that 8% increase in average selling prices on a 6% increase in volumes we mentioned. This ability to raise prices significantly without sacrificing volume points to a very strong competitive position and is a key driver of their organic profitability. If you look at Table 1 in our sources, you can really see the dramatic increases in construction products adjusted EBITDA and margin percentage from fiscal year 2023 to fiscal year 2024, and the healthy guidance for the consolidated total in 2025. It tells a very clear story of successful strategic execution.
Strong profitability often means strong cash flow, which is crucial for a company undergoing such a transformation and funding those big acquisitions. How is Arcosa managing its cash to fuel this ambitious growth strategy?
You're right. Cash flow is the lifeblood, especially for a company in an active growth and transformation phase. Arcosa has demonstrated strong cash flow generation, which is absolutely vital for funding its strategic priorities. In the fourth quarter of 2024 alone, they generated a robust operating cash flow of $248 million and free cash flow of $199 million. This momentum carried into 2025 with Q2 operating cash flow of $61.2 million and free cash flow of $39.2 million. That's a substantial improvement from a negative $6.1 million in free cash flow in the prior year's period, truly showcasing the enhanced cash generative capabilities of their transformed business. This consistent and improving free cash flow is essential for supporting their deleveraging plan, which is a major priority, as well as ongoing organic investments and ultimately future shareholder returns.
Okay, so the cash machine is working well.
If we connect this to the bigger picture, significant acquisitions, especially ones like the $1.2 billion Stavola deal, usually mean taking on a good amount of debt. What does Arcosa's balance sheet look like now, and what are their plans for managing that debt load?
That's the flip side of aggressive growth, isn't it? Debt can be a real burden if not managed carefully, potentially overshadowing even strong operational performance.
It absolutely can, and Arcosa definitely took on significant additional debt to finance that transformative Stavola acquisition in 2024. The $1.2 billion purchase was funded through a combination of $600 million and 6.875%, senior notes due 2032, and a $700 million variable rate term loan. This increased their pro forma net debt to adjusted EBITDA ratio to approximately 3.7 times at the time of the deal's announcement in August 2024.
Yeah.
That's a noticeable bump in leverage, which would typically give investors pause.
3.7 times. Yeah, that gets your attention.
It does. However, management has made it an explicit priority. Debt reduction is their near-term capital allocation priority. Their stated goal is to return to a target net leverage range of 2.0x to 2.5x within 18 months of Stavola's closing. And they've made rapid progress towards this. Their strong cash flow allowed Arcosa to reduce its net leverage ratio to 2.9x by the end of 2024 and further to 2.8x by the end of Q2 2025. This swift deleveraging demonstrates both the company's commitment to maintaining a strong balance sheet and, importantly, the powerful cash flow generation of its new business mix. It shows they're not just growing, but they're doing it with an eye on financial health and prudence.
So debt reduction is the immediate focus. How does this fit into their broader capital allocation philosophy, and what does it mean for shareholders right now? Are direct shareholder returns like dividends or buybacks taking a back seat?
Management's overarching philosophy is clear. They want to invest in attractive growth markets where Arcosa can achieve sustainable competitive advantages with a strong focus on improving long-term returns on invested capital, or ROIC. Their historical pattern has been one of aggressive, acquisition-fueled growth, followed by a period of integration and balance sheet repair. So, post-Stavola, that near-term capital allocation priority is indeed paramount debt reduction. They're aiming to use that strong free cash flow to rapidly deleverage. This creates an interesting tension, though, balancing the immediate need for deleveraging with potential M&A opportunities that might arise. It requires careful discipline, and management has clearly prioritized reducing financial risk.
Makes sense. Fix the balance sheet before looking for the next big thing.
Right. In terms of their acquisition and organic investment strategies, since 2018, their capital allocation has heavily favored inorganic growth, meaning acquisitions. They've deployed approximately $2.7 billion in acquisitions, primarily directed at building out their construction products and engineered structures segments. This has been complemented by strategic organic investments, such as new manufacturing facilities designed to enhance the capabilities of those acquired platforms. This balanced approach allows them to rapidly enter new markets or add new capabilities through M&A, and then invest organically to maximize the returns from those new platforms.
Given this laser focus on debt reduction and reinvestment, I'm curious, are shareholder returns like dividends or buybacks essentially on the back burner right now? Or is there still a strategic place for them, even if it's modest?
Currently, Arcosa's approach to shareholder returns prioritizes reinvestment in the business for long-term growth over large direct cash returns. Their dividend policy is a regular quarterly cash dividend of 0.05 cents per share, which at recent stock prices represents a nominal yield of approximately 0.2%. It's clearly not a significant component of their capital allocation plan at this stage.
Okay, so not really an income play right now.
Not at all. They also have a $50 million share repurchase authorization, which was renewed in December 2024. While this provides flexibility, significant repurchases are unlikely to be a priority while they're so focused on debt reduction. The message is clear. Growth and balance sheet health come first.
Got it. What about returns on capital? You mentioned ROIC. How are those metrics looking, especially after all the spending?
Yeah, let's look at return on invested capital, ROIC, and return on equity, ROE. Improving long-term ROIC is a stated goal of management and a key metric in their long-term incentive compensation plan. This isn't just any metric, it's a vital safeguard. For a company growing through acquisitions, the temptation to buy for growth's sake is immense. But by tying executive pay to return on invested capital, or ROIC, Arcosa ensures management is incentivized to make profitable acquisitions that actually add value, not just scale. It's a crucial alignment mechanism with shareholders. As of mid-2025, Arcosa's trailing 12-month ROE was 3.77%, and its ROIC was 4.55%. Those numbers seem quite low. They are relatively low, but that's a direct consequence of the large debt-funded acquisitions that have significantly increased a company's capital base, the denominator in those calculations. The ultimate test of their strategy's success will be Arcosa's ability to generate sufficient earnings from these newly acquired assets to drive these return metrics significantly higher over the coming years. That's really what investors are watching for.
Let's look forward then. Beyond M&A, how is Arcosa growing, and what powerful secular trends are set to be their biggest tailwinds? It sounds like they've got some massive forces at their back, almost like sailing with a strong, predictable wind.
They absolutely do. While M&A has been the primary engine, it's important to understand the broader context. The historical growth drivers have been that disciplined and highly focused M&A strategy, deploying roughly $2.7 billion since independence, mostly into construction products. This is a classic buy-and-build model. It involves acquiring established platform companies in fragmented, high-growth markets and then using them as a foundation for smaller, synergistic bolt-on acquisitions and organic expansion projects.
So it's like a private equity strategy, but played out in the public markets, constantly looking for opportunities to consolidate and optimize.
Precisely. And the specific acquisitions we've highlighted are key examples. ACG Materials in 2018 for $315 million, Cherry Industries in 2020, Stone Point Materials in 2021, Amerim Pole Products in 2024 for $180 million, and of course the monumental Stavola acquisition in 2024 for $1.2 billion. That's the cornerstone of its transformation. This private equity-style roll-up effectively consolidates fragmented industries like aggregates, creating significant value by acquiring smaller businesses at attractive multiples, integrating them for synergies, and benefiting from the higher public market valuations typically assigned to larger, more diversified entities. The primary risk, of course, is always execution, especially the successful integration of massive acquisitions like Stavola.
Right, integrating something that big is never easy.
Definitely not. Now, even with all the M&A, Arcosa also has significant current growth initiatives and capital investments in organic expansion. In 2024, for example, they were busy ramping up production at a new wind tower manufacturing facility in Belen, New Mexico. They also increased output at a new concrete utility pole plant in Florida, strategically placed to serve that rapidly growing Southeast market. A new greenfield aggregates operation in Texas was brought fully online, and they completed an expansion of their specialty plaster facility in Oklahoma. This demonstrates a balanced approach to growth, not solely relying on acquisitions, but also maximizing the potential of their existing and acquired platforms through smart, targeted investments.
Good to see that organic growth focus, too. So what about those future opportunities, the big trends?
Looking ahead, Arcosa is strategically positioned to be a prime beneficiary of several powerful, long-term secular growth trends in North American infrastructure, strongly supported by the AAA IRA funding we discussed. We're talking about things like grid modernization and electrification, the massive investment needed for expanding and hardening the U.S. electrical grid, driven by data centers, electric vehicles, onshoring of manufacturing, directly drives demand for Arcosa's utility transmission and distribution structures. A powerful piece of evidence for this is their record $450 million backlog for utility structures at the end of Q2 2025, providing a clear line of sight to future revenue.
That's a huge tailwind for their engineered structures segment, providing real demand visibility for years to come. A very solid backlog.
Absolutely. The energy transition, fueled by IRA tax credits, underpins long-term demand for wind towers. While this can be cyclical based on policy and project timing, the underlying shift towards decarbonization provides a multi-decade tailwind. And of course, highway and bridge construction with IIJA funding expected to drive a multi-year investment cycle. As a major aggregates producer in key growth states, Arcosa is incredibly well positioned to capture this demand. The company's substantial backlog for utility, wind, and related structures stood at $1.2 billion at the end of 2024, providing strong revenue visibility for 2025. Even the barge backlog of $277 million at the end of Q2 2025 provides visibility into 2026. These are real, tangible growth engines that create a significant runway for the company.
This all sounds very promising, but the last few years have been tough for many businesses. What specific challenges has Arcosa faced between 2022 and 2024, and how did they adapt, especially as they were actively transforming the company?
Indeed. Between 2022 and 2024, Arcosa navigated a complex macroeconomic environment. They faced persistent inflation, rising interest rates, and ongoing supply chain disruptions, just like many other businesses. Specifically, the impact of supply chain disruptions and material cost inflation meant volatility in commodity markets like steel and challenges in labor markets with wage inflation and skilled worker shortages.
So the usual suspects for any industrial company recently.
Pretty much. However, Arcosa's management successfully managed these pressures through a combination of operational efficiency and exercising their pricing power. Their strong aggregates market position, in particular, allowed them to successfully pass through cost increases and protect margins, which is a key advantage in an inflationary environment. In engineered structures, they demonstrated an ability to manage profitability through steel price cycles, balancing product mix and volumes even as steel costs fluctuated. The effects of interest rate changes on end markets were also significant. The Federal Reserve's aggressive rate hikes to combat inflation cooled residential and private commercial construction, which would normally be a headwind for parts of their construction products of business. However, this was partially mitigated by that significant, less interest rate-sensitive public infrastructure spending from the IIJA, which served as a crucial buffer.
So the IIJA really helped cushion that blow.
It did. The M&A environment itself became more challenging. The higher cost of debt and elevated operating costs for acquired businesses increased the financial hurdle for M&A, magnifying the pressure to flawlessly execute the Stavola integration. It was a period where every decision had to be precise.
So their biggest adaptation to these tough conditions was essentially the transformation itself. They didn't just react, they proactively reshaped their entire business.
That's precisely it. Arcosa's transformation is its adaptation to post-pandemic market conditions. They recognize the heightened volatility and cyclicality inherent in their legacy manufacturing businesses and made a decisive pivot. The divestitures of their storage tanks business in 2022 and the steel components business in 2024 were explicit moves to shed those more volatile, lower-margin assets. Concurrently, their aggressive investment in the more stable, locally focused, and higher-margin construction materials space represents a strategic repositioning toward a more resilient business model, one better suited to navigate ongoing economic uncertainty. It was a proactive, well-orchestrated, and significant response to a changing world.
Ultimately, a company's success often comes down to its leadership and how they steer the ship through these complex waters. What can we say about Arcosa's management team and their approach to corporate governance? Do they have a track record of execution?
Management quality and corporate governance are absolutely critical for long-term value creation, especially for a company undertaking such a fundamental transformation. Arcosa is led by President and CEO Antonio Carrillo, who has been the architect overseeing this significant portfolio transformation. The board of directors is also composed of individuals with deep and relevant experience in manufacturing, construction, transportation, and finance, ensuring effective oversight across their diverse operations.
So experience at the top, have they delivered?
The management team has demonstrated a strong capability to execute its stated strategic vision. Their long-term goals of growing in attractive markets, reducing complexity and cyclicality, and improving returns on capital have been matched by very decisive actions. The divestiture of cyclical manufacturing assets and that series of acquisitions to build a leading construction materials platform are tangible evidence of the team's ability to translate strategy into reality. And importantly, the financial results, particularly the consistent and significant margin expansion, further validate the effectiveness of this execution. They walk the talk, which is vital for investor confidence.
It sounds like they've built a solid foundation of trust and demonstrated competence. And what about their governance practices? Are they aligned with best-in-class standards?
Their corporate governance practices incorporate several best practices designed to ensure accountability and shareholder alignment. For example, the board of directors consists of 9 members, 8 of whom are independent. Crucially, the roles of chairman and CEO are separate, with Rice J. Best serving as an independent, non-executive chairman. This structure is widely considered to enhance board oversight of management.
Separate chair and CEO, that's generally seen as a positive.
It is. The board also exhibits strong diversity, with over 50% of its members identifying as ethnically or gender diverse, which can bring a broader range of perspectives to strategic decision-making. They also have strong shareholder rights and protections, like a NYSE-compliant clawback policy for incentive pay and a strict policy prohibiting directors and employees from hedging or pledging company stock, ensuring their economic interests remain directly aligned with public shareholders.
Good safeguards in place. How about pay? Is executive compensation aligned with performance?
On the topic of executive compensation and shareholder alignment, Arcosa's program is heavily weighted toward performance. A significant portion of executive compensation is at risk. For the CEO, approximately 84% of total compensation is tied to performance-based annual and long-term incentives. Their long-term incentive, or LTI plan, is particularly well aligned with shareholder interests. Awards are based on performance over a 3-year period and are tied to a mix of metrics. Average pre-tax return on capital at 40%, cumulative adjusted earnings per share at 40%, and relative total shareholder return versus a peer group at 20%.
That sounds like a robust system with clear metrics tied to long-term value creation, especially that ROIC component. Has it actually paid off for them and for shareholders?
It has. The performance-based stock units for the 2022-2024 cycle actually paid out at 194.4% of target, reflecting the company's strong performance against its multi-year goals.
Wow, nearly double the target.
Exactly. What's a crucial detail here, and a powerful insight, is the inclusion of ROIC as a heavily weighted metric in the LTI plan. For a company pursuing a capital-intensive, acquisition-based strategy, there's always a risk of management pursuing growth for its own sake, rather than profitable growth. By directly tying a large portion of their compensation to ROIC, the board incentivizes the executive team to be disciplined capital allocators, making acquisitions at reasonable prices and operating them efficiently to generate returns that exceed the cost of that capital. This provides a powerful internal check against value-destructive M&A and strongly aligns management's interests with those of long-term shareholders.
Here's where it gets really interesting for someone looking at this company. With all this transformation, how should we think about Arcosa's valuation? Has the market caught on yet to this new identity, or is there, a disconnect?
Valuation for Arcosa is indeed a complex picture, precisely because of its fundamental business transformation. Simple historical comparisons are actually insufficient. They were, in essence, a different company then. A nuanced analysis really requires benchmarking against a new, more relevant peer group of construction materials companies, while still accounting for the remaining business mix differences and their financial structure.
Okay, so throwing out the old comparisons, what do the current numbers look like?
Let's look at their current and historical valuation multiples. As of early September 2025, Arcosa's trailing 12-month, or TTM, price-to-earnings ratio was in the range of 51.53x. This metric is significantly elevated and likely distorted by acquisition costs, non-cash depreciation and amortization from purchase price accounting, and the partial year contribution of divested businesses. It's not a reliable indicator of their underlying earnings power right now and can be quite misleading.
So that TTM-PE ratio is a bit misleading given everything that's happened. What are the more useful metrics for a company in this stage of transformation, something like EBITDA?
Exactly. More meaningful metrics are forward-looking, or based on enterprise value. The company's forward PE ratio was approximately 23x, and its TTM EV-adjusted EBITDA ratio, which is enterprise value to earnings, Before interest, taxes, depreciation, and amortization, a key metric for value in businesses that have undergone significant M&A was approximately 13x. While the current trailing PE is well above the company's 5-year average of about 29x, this historical comparison has limited utility as the prior valuation was based on a more cyclical, lower-margin business. The key question for us now is whether it's appropriately priced for its new, higher-quality earnings stream given the strategic pivot.
Okay, 13 times EBITDA. How does that stack up against the companies they should be compared to now? The construction materials guy.
This raises an important question. If Arcosa has transformed so profoundly, why isn't its valuation already fully reflecting that new, higher-quality identity? Let's dive into the comparable companies.
This is where we see if the market is truly recognizing their strategic success or if there's a valuation gap that savvy investors might be looking at.
To properly assess Arcosa's valuation, it's essential to benchmark it against the leaders in its new key end markets. Their transformation means their most relevant peers are now the large-cap U.S. aggregates producers. If you look at Table 2 at our sources, it reveals a clear valuation discrepancy. Arcosa, ACA, currently trades at an EV/LTM EBITDA of approximately 12.9x. Now compare that to its closest U.S. aggregates peers. Vulcan Materials, VMC, trades at around 20.1x, and Martin Marietta, MLM, is at approximately 19.1x.
Wow, 13x versus 19x or 20x. That's a pretty significant gap.
It's a huge gap. These large-cap U.S. aggregates producers trade at substantially higher multiples. Interestingly, Arcosa's multiple of around 13x is more in line with a larger, more geographically diversified global player like CRHPAS, which is around 13.1x, or even a steel producer like Nucor NUE at 11.1x. The biggest insight here is this. Arcosa isn't just trading at a discount, it's arguably being mispriced for its past identity. The market hasn't fully caught up.
So what does this all mean? How do investors interpret this valuation gap? What's the bull case and the bear case for Arcosa? It sounds like there's a big debate here on Wall Street.
There absolutely is. The investment debate surrounding Arcosa is centered precisely on the interpretation of this valuation gap and what it implies about the company's future. The bull case argues that this discount to VMC and MLM is entirely unwarranted and represents a significant investment opportunity. Proponents of this view would contend that as Arcosa successfully integrates the massive Stavola acquisition, continues to deliver on its impressive margin expansion, and systematically reduces its leverage, the market will eventually be forced to re-rate the stock. This means its valuation multiple will climb to be more consistent with its pure-play construction materials peers. The combination of this potential multiple expansion on top of its underlying EBITDA growth could, in theory, lead to substantial shareholder returns. The valuation gap isn't just an anomaly, it's the market lagging behind a profound, deliberate transformation, creating a clear arbitrage opportunity for those who understand the new Arcosa.
So it's about the market catching up to the new reality of the business, betting on that re-rating. But what's the opposing view? Why would someone be more cautious seeing this discount as justified?
The bear case posits that the current valuation discount is, in fact, justified, or at least partially justified for now. This view holds that Arcosa isn't yet a pure-play aggregates company. It still retains considerable exposure to the more cyclical, engineered structures and transportation segments, which inherently carry higher volatility than a pure aggregates business. Furthermore, its balance sheet, while improving, is still more leveraged than its larger, more established peers, which introduces greater financial risk in uncertain times. The significant execution risk associated with integrating an acquisition the size of Stavola also warrants a valuation discount until a consistent track record of success in integration and synergy realization is firmly established. There's a show-me factor at play.
The prove-it argument makes sense.
Exactly. So, the bottom line for you, the investor, is that the investment case for Arcosa really hinges on this potential for a valuation re-rating. The key question is determining how much of this potential is already reflected in the current stock price and forward estimates, versus how much upside remains if they flawlessly execute. Analyst consensus price targets of $112, $116 suggest a moderate upside of 17–18% from early September 2025 prices, which indicates that Wall Street may already be pricing in some degree of future success. Any stumble, however, could cause the valuation gap to persist or even widen.
So some upside priced in, but maybe not the full re-rating story yet. Depends on execution.
This raises an important question. With such a strong growth trajectory and strategic shift, what are the biggest factors that could derail this positive outlook, and what should we be keeping a close eye on? Every investment comes with risks, and for a company undergoing such a transformation, these are particularly important to understand.
Absolutely. No company operates in a vacuum. And understanding the potential pitfalls is just as crucial as understanding the opportunities. What keeps Arcosa management up at night?
Precisely. There are several key risk factors and considerations. First, the economic cycle and market volatility. Despite their strategic shifts to reduce cyclicality, Arcosa's businesses remain fundamentally tied to the health of the broader economy. A significant recession could reduce construction activity, lower industrial production, and decrease demand across all three segments, impacting their performance. Arguably, the most significant company-specific risk is acquisition integration risk. The $1.2 billion Stavola acquisition was a truly transformative transaction, significantly increasing Arcosa's scale and complexity. A failure to successfully integrate Stavola's operations, retain its key management and customer relationships, or realize the projected cost and revenue synergies would have a material adverse effect on Arcosa's financial results. It could even lead to significant goodwill impairment charges, essentially, writing down the value of the acquired company on their books because it's not performing as expected. That's a real hit to reported earnings and investor confidence.
That integration piece sounds absolutely critical then. Huge potential upside, but also huge risk if it goes wrong.
It really is. Then there's financial risk and leverage. To fund Stavola, Arcosa took on a substantial amount of debt, increasing its net leverage to a pro forma peak of 3.7x adjusted EBITDA. While it's been reduced to 2.8x by Q2 2025, it remains elevated. Any unexpected downturn in earnings could make servicing this debt more challenging and constrain their financial flexibility for future growth or shareholder returns. We also have regulatory and environmental compliance risks. The construction products segment, especially aggregates, is subject to extensive and evolving federal, state, and local regulations concerning quarry permitting, land use, and environmental standards. Changes or difficulties in obtaining permits could increase costs, delay projects, or limit future growth.
Always a factor in materials and construction.
Definitely. There's also some customer and end market concentration. The engineered structures segment has a degree of customer concentration, particularly in wind towers, which relies on a small number of large wind turbine OEMs. The loss of a major customer here could significantly impact that business line. Furthermore, demand for wind towers is highly dependent on the continuation of favorable U.S. government policies and tax incentives under the IRA. Any adverse changes could significantly reduce demand.
So policy risk on the wind side, too.
Yes. And finally, raw material and supply chain risks. Arcosa is exposed to price volatility in key raw materials like steel for its engineered structures and transportation product segments, as well as energy inputs like diesel and natural gas for all its operations. Rapid, unexpected spikes in these input costs could temporarily compress margins if the company is unable to pass them through to customers in a timely manner.
Okay, quite a few things to keep an eye on. What about the potential positives? What catalysts could really drive the stock and validate the bull case?
On the flip side, for those closely following the story, there are also key catalysts and monitoring points to watch for in the next 12-24 months that could drive positive outcomes. On the positive side, successful Stavola integration, reflected in consistent strong quarterly results, margin accretion, and synergy realization, would be a powerful validation. Accelerated deleveraging, reaching their target range ahead of schedule, would de-risk the balance sheet and free up capital. Major project announcements for wind towers or utility structures would boost backlog and revenue visibility. An acceleration of IIJA-funded projects at the state level would directly benefit aggregates volumes. And finally, valuation multiple expansion, if Arcosa's stock gets re-rated to closer align with pure-play aggregates peers, would be a significant driver of shareholder returns.
And what are the specific negative catalysts or warning signs listeners should be tracking, the red flags?
A significant economic downturn, as we mentioned, would be a major headwind. Any integration challenges with Stavola operational issues, cultural clashes, customer losses would be highly detrimental. Adverse policy changes, for instance, reducing IRA wind energy credits, could severely impact their wind tower business. And input cost shocks like steel or energy leading to margin compression that they cannot pass through to customers would erode profitability.
So what are the key numbers or indicators we should watch quarter to quarter?
So when you're monitoring Arcosa, here are the key metrics and indicators to track. The construction products segment margin, specifically adjusted segment EBITDA margin and aggregates adjusted cash gross profit per ton, is paramount for gauging the success of their strategic pivot. Keep a close eye on their net debt to adjusted EBITDA ratio quarterly for deleveraging progress. Monitor the engineered structures backlog for future revenue visibility. Track their free cash flow generation for capital allocation capacity. And analyze quarterly aggregates, volume, and pricing trends to assess market health and pricing power. These will give you the clearest picture of their ongoing journey. Hashtag tag outtag outro.
We've taken a deep dive into Arcosa Inc., exploring its dramatic transformation from a diversified industrial manufacturer to a focused construction materials powerhouse. We've seen how strategic acquisitions, crucial divestitures, and a deliberate focus on less cyclical markets, bolstered by massive government infrastructure spending, have fundamentally reshaped its identity and financial profile. It's truly a masterclass in corporate repositioning and a compelling narrative of self-reinvention.
Indeed, Arcosa's story is one of a company actively engineering its own future, navigating both significant opportunities and considerable risks. The journey from a spinoff to an aggregates-led entity, with its disciplined approach to capital and a clear vision for capitalizing on long-term infrastructure trends, is certainly one to watch closely. The insights from this transformation extend far beyond just Arcosa, offering, a blueprint for how companies can proactively adapt to changing economic landscapes.
So what does this all mean for you? As Arcosa continues its journey to fully realize its potential as a construction materials leader, what do you think is the biggest unappreciated factor that will determine its ultimate success? Is it flawless integration of those massive acquisitions, the continued and timely flow of federal funds for infrastructure, or something else entirely that we haven't even touched upon today? Perhaps it's their ability to secure even more advantageous geographic moats, or maybe manage that mixed cyclicality in engineered structures. We encourage you to keep exploring, keep questioning, and keep digging deeper into the fascinating world of infrastructure. We'll see you next time on The Deep Dive.